The broadcast is now starting. All attendees are in listen-only mode.
Hello everybody, welcome to Bursa Malaysia's webinar titled Master the Game of Stock. Now before we proceed further, just want to check if you can hear me clearly. So on your control panel there's the raise the hand button. So if you can hear me, could you please click the raise the hand button? And if you also can see my screen and my webcam, please raise your hand. Thank you so much. You may put down your hands now. Okay, now this webinar is live and we are doing it for the second time for this year. And in this webinar, we'll share with you what are the trading processes and what are basic things that you need to learn as a stock investor. So in this webinar, we will separate into two segments. The first segment is 60-minute content, followed by 30 minutes Q&A. So if you have any questions, you may do it at the end of the 1 hour content. Now, I think maybe some of you here got question in regards to the, the market development these 2 days because the market hasn't been doing very well, and then the US is all dragged down by the US market. So, well, we will see what the speaker has to say later. Now, today we are very honored to have invited PC Wong, who is our speaker for today. And for those of you who have followed our webinar series, of course, he is no longer a stranger to you. Now, before we begin, just want to talk a little bit about the disclaimer. Now, whatever we share on Bursa Malaysia platform is only for educational purpose only. In no way that we are responsible for your financial decision. So you do it at your own. You invest on your own financial risk. Okay. Now, so without further ado, let me introduce the speaker today. He graduated from NUS in 1989. He had 26 years of working experience with several public listed companies, and he is also a best-selling author of Invest in REITs, which reads Popular's top 10 non-fiction bestseller. He's a full-time investor, so he has no job. He's invests full-time, and he's also a trainer and author. Now, he's also featured on several media such as Bernama and Sincho to share about investing and the economy. Now, without further ado, let me give control to you, PC.
Yeah,
Take
thank
it
you,
over.
Shane, and thank you all for tuning in. So let's talk about master the game of stock. Today we'll discuss about the trading process, the role of Bursa, Security Commission, and brokers, understand the risk and rewards, understand transaction and investment cost, understand the financials of a company, and understand the economic indicators. Now, trading process, how to start. We'll talk about role of CDS and understanding the relationship between volume and price and placing an order. Now, how to start? First of all, you need to open the trading account, okay, and a central depository system, CDS account at the local brokerage firm or an investment bank. The trading account allows you to trade, which is to buy and sell securities listed on the Bursa while keeping track of your transactions. You can also apply for trading online to retain the services of a broker to help you to trade. Okay, so there are two choices. Normally nowadays people would prefer to trade online themselves, but some would prefer to use the services of a broker in case if they do trading online with a mobile phone and they have a fat finger syndrome. Adding 10 could be very disastrous here if you are doing a buying. So sometimes people want to pass the risk to the broker and they prefer to use the services of a broker. But trading online would actually let you monitor and keep progress of your trade, whether the full quantity that you are buying or selling has been met. Okay, so that's why a number of people are using trading online nowadays. Okay, then the CDS account is an electronic scripts manager where all securities are deposited and transferred from seller to buyer seamlessly. Now, this is how the process would look like. This is a trading environment or trading platform. You have the buyer and the seller both asking, the other is bidding. Okay, so when the buyer and seller agree to a price for 1,000 shares of a company, okay, this agreement between both, okay, would the movement of shares would go through the CDS, where the seller's account is debited with 1,000 share, which means that 1,000 share in this account is removed and then transferred to buyer's account, and buyers would be credited with 1,000 shares of a company. So talk about volume and price relationship. Now, very often there is some misconception about it, and this is to offer some clarity. Yeah? Now, if the number of buyers is more than the seller, demand is high and price will go up. If the number of sellers is more than buyers, demand is low, price will go down. So it's very similar like the laws of supply and demand, okay, basic economics theory. So, however, do not equate volume with price, because high volume is not equal to high demand when sellers are more than buyers. Okay, in this scenario, price will go down. So you really need to look at how the price perform, okay, and the volume. Sometimes we see that the volume is picking up, and then we think that, hey, you know, that stock must be in demand, and then we also put in a buy order. Okay, even though the price then, okay, is not showing a huge positive, okay, but rather a slight negative. So sometimes we can make that mistake in assuming that high volume means there's more demand. If let's say a seller, a major shareholder, let's say, is unloading his shares into the market, you will also have high volume, okay, but then the price can drop very drastically. So you need to distinguish the two. Okay, the high volume is not equal to high demand. Okay, now if high volume is equal to high demand when buyers are more than sellers, in this scenario, price will go up. Okay, now if you go to the Bursa table, okay, where they have all the various stocks, you know, you have the buyers volume, you have the sellers one, that would help you determine whether buyers are more than sellers or sellers are more than buyers. Okay. And price can go up when volume is low because buyers are more than sellers. Okay, price is not dictated by volume but by demand. Okay, by the number of buyers, and supply, the number of sellers. So to trade, you need to place an order. Okay, so a buy order is when you place an order to buy a security. A sell order is when you place an order to sell a security. In a trading platform, okay, you will normally see the company name being displayed, okay, with the share code and such, okay, the buy price, sell price, and buy volume, sell volume as following. Now, let's say we have company XYZ. Last transaction is $1.90. Volume of trade done is 63,000. Buy volume now is 89,000. Buyers is bidding at $1.90, while sellers are asking for $1.91. Okay, the sell volume is 150,000. Okay, so you can place a buy order at ringgit 1.91. Okay, you have a high chance of success because you are buying at the seller's asking price. Okay, so if let's say you decide that company XYZ seems to have a very good potential, okay, then you decide to place an order, okay, and you want to get the company as soon as possible rather than to put it on queue. So then you would put in a price of $1.91, okay, so that you are buying what the seller is asking and you get the shares immediately, okay. Or sometimes you want to bargain, okay, you believe that the seller would actually sell to you 1 cent lower because you are not far away from the asking price. So you may bid at $1.90, and therefore your trade, okay, your order would be on queue. So conversely, if you place a sell order, okay, at $1.90, okay, you have high chance of success because the buyers are asking for $1.90 only. Okay, so then if you feel that you want to sell this share, this company share very urgently, then you just key in the price that the buyer is bidding. Okay, so if you decide that you want to have a better price, okay, then you put in 1 ringgit and 91 cents, and your sell order would be on queue. Okay, to determine whether that particular share, okay, is in high demand or not, you just need to look at the buy volume and sell volume. Okay, and then if let's say sell volume is more than the buy volume in this case, okay, 150,000 versus 89,000, then it's okay for you to put bidding price at 1 ringgit and 90 cents because sellers are actually more than buyers. Okay, or you may not want to put that 1 ringgit and 90 cents. You believe that as the day wore on, because seller volume is getting greater, okay, then you may put in at 1 ringgit and 88 cents instead of waiting for the opportunity that more sellers would emerge, and then they would actually be asking a much lower price as they want to liquidate their holdings. So this is how you actually monitor, okay, the buy volume and sell volume to determine at what price level you want to enter or sell. Now this is the actual price and volume, okay, chart from Bursa. Okay, you have the last done, which is the last price that the share was traded. Okay, then you have the change. Okay, and then you have the percentage of change. Okay, this is the volume done. Okay, then you have the buy volume here. Okay, you have the sell volume here. Now this is the bidding price. This is the asking price. So in this case, you will see that sell volume is much higher. So you might not want to buy at 43 cents, 43.5 cents. You may want to put at 43. Okay, or 42.25. So this is how you look at the you look at how the behavior of the the buyers and sellers. Okay, the amount of buyers and sellers in the market, and to determine whether at which price level you want to enter. Now, this is the high and low, which means the high of the day and the low of the day. Okay, so this is the high price means at the highest price that the share was transacted, okay, up to that moment. Okay, for example, now it's only, let's say, 11 a.m. and then you have this high, okay, at 44 cents. Okay, it means that if, let's say, the share price eventually continue to go up, then the high for the day would actually change as well. If, let's say, the share price suddenly drop as the day wore on, then you could have a new low. Okay, so sometimes people would look at the last price, okay, last done, okay, versus the high and low. Okay, then if, let's say, if 39.5 cents is already the new low at that time, okay, and that's the versus the 43.5 cents done, then it may indicate that there's demand picking up, okay, because it moved up from the low. Okay.
Okay, yeah, before we move on, I just wanted to do a quick poll. All right, so on your screen now, I just want to make it more interactive. On the screen now, there's a poll on where do you think KLCI will go tomorrow. So if you think that KLCI will go up more than 30 points, just pick the one, or down more than 30 points, or in between. So we'll just take a short quiz to see where do you think it will go. Right.
Okay. So the role of Bursa. Now, Bursa is to ensure that the price information for
yeah, they can't see your screen now. I'm not yet done with the poll.
Oh, okay.
Yeah. Meanwhile,
okay,
you can check your chat group. I sent a message to you. All right. So we are in the meantime. Let's look at the poll, and I only have 79%, 80% of you voted. I've all right. So I've 89% of you voted. So let's close the poll now, and just want to share the result. Okay, now 1% of you say that the KLCF will go up more than 30 points tomorrow. And then 25% of you say that it will be up in between 10 to 30 points tomorrow, while 40% of you will think that it will fluctuate, and 6% of you think that it will down another 30 points tomorrow, which is very bearish. And then there's 28% of you think that it will be down 10 to 30 points tomorrow. So that's about the result. But in general, I would see that more people are bearish than more people are bullish tomorrow. So well, we will see. Now in the meantime, PC, there's a question asking, what is LACP? On slide 11, you mentioned that there's LACP. So could you explain that?
I think that's the lowest done. Let me check. Yeah, it's the same as the lowest done. Okay. Yeah, normally I would often keep track of the last done because that is more of the current pricing. Okay. If you want to put in a buy or sell order, it is very important for you to use the last done rather than the high and low, because those are just reference points, okay, including the LACP. Okay, so for me, normally I would use last done, okay, then the buy and sell volume, okay, and then the buy and sell price. These are just reference points, okay, for me. And if let's say if let's say there are certain movements sometimes in the share price that it suddenly moved up, would you normally do a search on what's in the news, or you follow a particular trend? Now, if you are a trader, maybe you would follow a particular trend. But for me, normally, if let's say there is a price that is suddenly moved up, then I would do a quick search, okay, go to the company to find out what's going on. Because sometimes it could be sentiment driven, okay, but nothing of important of news, no important news that comes out. So if that is the case, then that is just a sentiment and may not last very long. Okay, so it's very important for you to really find out what's going on, okay, so that you will be able to know for sure that what makes the price of a stock move up or down. Okay, for example, if there's sudden high volume of sellers, okay, then you have to do a quick search and find what's wrong if you are a value investor. And if you are a trader, you might just follow that sentiment. But often, if let's say it's driven by sentiment, it can go up very suddenly and come down very suddenly too. Okay, so that's those are the things that you should be aware of. Yeah.
All right. So are you ready to proceed?
Yeah.
Yeah, it's showing your slide now.
Okay, hold on. Okay, the role of Bursa, it is to ensure, okay, the pricing, information for securities and trading on the exchange, so that all this information is disseminated efficiently. Ensuring the fair and orderly trading of securities, ensuring Sharia compliance in securities testing for the Islamic market, supervising the stockbroking and listed companies, and enforcement by imposing fines and reprimands when regulations are breached. Okay, So they also punish companies when they fail to disclose certain important transactions or certain important news. Okay, you might sometimes, if you are following company announcements, sometimes they might announce that they received a question from Bursa regarding the volatility in the stock. Suddenly, the price jump exceeding, let's say, 10% or 30%, you know, and there's a lot of market rumors and all those things. So Bursa sometimes will issue a notice to the company to explain what's driving the certain volatility in that particular company's stock. Okay, so these are some of the supervising thing that Bursa does. Okay, so that you know the public have to know whether the company did disclose or failed to disclose certain information. So normally they will send a notice asking the company to clarify certain questions that Bursa might ask. Okay, then the other thing that Bursa does is to approve listing and security quotations. Okay, approving listing and security quotations, then regulating disclosures by public listed companies. Okay, so this is how Bursa would regulate. Okay, and if let's say companies fail to disclose, okay, and if they deem it that is punishable, then they would normally fine the company. Okay, but if let's say there are certain more so-called severe, okay, severe thing that the company has failed to disclose, okay, or even some insider trading, then a company director can be charged in the court of law as well. The other thing is maintaining a website of information on the Malaysian capital market, including price information, listed companies, profile, announcement, etc. So there's a lot of things that Bursa does, okay, to ensure that the Malaysian companies, okay, are well regulated, and to avoid to make sure that companies toe the line when it comes to disclosing their transactions or disclosing their various announcements.
Okay, now so for more information, you can visit www.bursamalaysia.com to find out. But PC, one thing I noticed that is that you may not be used. All right, cool. Yeah, sorry, go ahead.
Yeah, so the role of Securities Commission. The Malaysian Securities Commission was established on 1st of March 1993 under the Securities Commission Act of 1993. It is a self-funding statutory body with investigative and enforcement powers and reports to the Minister of Finance. Its functions include supervision of exchanges, clearinghouses, and central depositories, registering authority for prospectuses of corporations. Okay, sometimes when companies prospectus are actually what a company would issue, okay, would publish, okay, during the stage of IPO, okay, because they need to disclose to the public how is the company performance, okay, during a specified time, and that's disclosed in the prospectus, so that people then can actually decide whether to invest in that particular company or not. Yeah, and the Securities Commission would also be the approving authority for corporate and bond issues. Bond issues are normally when companies they want to tap onto the market, okay, to get funding, okay, for their expansion, okay, or for a takeover. So normally they would issue a bond. A bond is like a debt, okay, which the company would promise to pay X percentage of interest, okay, on an annual basis for the duration of that bond to the investor. So in this case, the Securities Commission would be the approving authority for corporate bond issues. Then they also regulate all matters relating to securities and derivatives contracts, takeover and mergers of companies, and unit trust scheme. Now, sometimes when it comes to takeover, okay, and mergers, the Securities Commission would actually want to examine whether that takeover maybe could result in a monopoly, okay, and that could be, let's say, bad for the consumers, okay, in which case some mergers may not be approved, okay. So sometimes it's not that because a company is rich, they want to take over another company, and it's just as easily they can buy up the shares and so forth. Because sometimes the regulating body also have to consider, would it result in, for example, monopoly, and whereby consumers would be left out, okay, in a sense that it's up to that particular company then to dictate the pricing, or that, or sometimes the takeover could be at the detrimental of the country as a whole, okay. So these are the things that the Securities Commission would examine when it comes to takeover and mergers. Then they are also involved in the licensing and supervising of all licensed persons, okay, encouraging self-regulation, ensuring proper conduct of market institutions and licensed persons. This has a lot to do with, let's say, fund managers, okay, brokerage firms and such, then to promote the development of the securities and derivatives markets in Malaysia. Most important of all is to protect the interests of investors. Now, for more information, you can actually visit www.sc.com.my. So the role of brokers. Brokers are often referred to as brokerage firms. Yeah, brokerage firms are financial institutions that facilitate the buying and selling of financial securities between a buyer and seller. So sometimes you can do it through a broker that is representing the brokerage firm, okay, or you could do via the brokerage firm's online platform. Yeah, so there are two ways which you can do, okay. So they are also a financial institution, so therefore they are regulated by the Securities Commissions of Malaysia, and they must meet such conditions such as adequacy of funding and proper corporate governance, okay. So the other thing is understanding the risk. Now, investing in a company carries risk, okay? Profit is never a guarantee. So it is a priority to understand the level of risk inherent in a company you wish to invest in. How do you grade a company's risk? You need to understand its underlying financial strength. Now, that is the first and foremost consideration. Because if you do not understand the company's financial strength, very likelihood you will be buying into a company which is heavily indebted, okay, and with less potential. So what happens is during a period of economic crisis, okay, you will certainly see that the company performing not even worse, but it could be going under, okay, because of its heavy debt. So understanding the underlying financial strength of a company is important because it will determine whether a company will be able to survive in a financial or economic crisis, okay. So that when you're able to do that, okay, you will not be buying blindly. Okay, now a lot of people, when they start to invest in stocks, very often, ever since I started at a very young age, in my 20s, okay, when I first started, I do not know how to evaluate a company. So what I do is I listen to my uncle, and when I say, how do you know? Then he would say, oh, they say, okay, then who is they? Okay, so often we often rely on other people's information before we want to invest. Now that is something that I do not fully agree with at all, because you must understand, because that company that you invest in, that company is going to work for you, okay. They must be able to generate income for you. They must be able to generate capital gains for you. So it's very important that you know the company fully well, okay. Otherwise, okay, when you listen to rumors or listen to someone who knows someone, within the company and say that, hey, this stock will go up and so on, you might be on the last receiving end, okay. You will not be buying okay, with the knowledge that there's potential. You will be buying when that potential, is being realized, and therefore you will not gain that kind of capital appreciation. So when you understand the financial strength of the company, you would be buying a company that you understand and you know that it's strong, is able to withstand shocks from the external markets, okay? Then your investment will be less risky, okay? So the other thing is knowing its growth potential, as I mentioned just now, okay? When you understand the company's growth potential, you know that in the near term, what will be the future of the company is, okay? And if you do not know the growth potential of a company, then you will be buying blindly, okay, with the hope of capital appreciation. Now, then you will be smoking on hopium, okay, because you are hoping, okay, you are not doing your own, you are not understanding the company's financial strength, you are not understanding its growth potential. So when you understand growth potential, then you will realize that you can keep track of a company's performance every quarter, and at each quarter where the company's performance exceeds expectation, then you can actually keep on reviewing your price target for that company, okay, so that if the performance exceed, for example, your exit point is 20% capital gain, okay, but then that company exceeds expectations in its performance, then you might want to say that, hey, I'm not going to exit at 20%, I'm going to exit at 30% because I understand the potential. So then when you know the potential, you can actually start grading that company, and as its performance reveal, you could then decide whether you want to increase, rise up your price target, or actually if the performance starts to turn back, then you may want to exit so that in the future you will not experience a loss from your investment. So that is what I mean by understanding the growth potential of a company. Then you must also know the prevalent economic conditions. Now, a very good example is just now when Shane did a poll. Okay, some of you think that because the KLSE, okay, has fallen X number of points today, I think it's 30 points or so. Initially it started to drop even much lower. Okay, so some of you may think that Shane, you want to add something?
Yeah, I mean today it dropped 40 points.
Okay, you're right. So let's say because when I saw in the morning, I think it was down about 55 points if I'm not wrong. Okay, so for example, the KLSE, is down 40 points today. So you might think that because it's down severely today, okay, buyers would step in, okay, and then they will start investing because it has fallen by 40 points. Now, but if you know what's happening in the prevailing economic conditions, not only in Malaysia but global, okay, very much of the stock markets in the world are dependent on a few major markets, okay. It's the US and China. These are the two markets that you must know. If any of these two sneezes, the entire world catches flu, okay. So like the US, okay, you know that it has fallen yesterday, and therefore the KLSE has fallen today. But how do you know whether the KLSE will be falling tomorrow? Okay, now what you can do is watch the performance of the US stock market tonight. Now, for me, I will look at the US futures market, and it's indicating that tonight, there's going to be another sell-off. Okay, so that's why you need to correlate back. Now, assuming that the US market already closed in the morning, and then when you wake up in the morning at 8 o'clock, then you just check how's the US market did. If the US market did poorly, then for that day the KLSE would also be doing quite badly as well. Okay, and sometimes we think that, hey, institution funds would step in, okay, when the market is trending down. Yes, they will step in when the market is trending down. But when there is a heavy sell-off, like in the Dow yesterday, there was a sell of 1,175 points, okay, then, institution funds will be very hesitant as well, because what if the market drops further, okay? So that's why sometimes you must know what's happening outside of Malaysia as well as what's happening within, okay? And like the behavior of the stock market, you have to correlate what's happening outside of Malaysia, because it will influence the risk appetite of investors in Malaysia. Okay. Then the other thing is understanding the management directions for the company. Now, the management's direction is very important because they lay down, okay, where the company would go in the future, okay, whether it's in the near term, okay, or in the longer term. Some companies, okay, they would announce what they are going to do, okay, and how are they going to do it. Now, if a company will share all this, then that means the management wants to be very approachable with the shareholders, okay, which is good, okay, which means the management understand what the shareholders want, and they are sharing with them what they intend to do to fulfill their own ambition, okay, in with regards to the company. So sometimes management, you see the quarterly report, and then there's just a few lines when it comes to review of performance, okay. The company will just say that, hey, we did this compared to last year, year on year, and then this and that, then there's nothing much to say, okay. But of course, if they perform badly, then they will have a lot of things to say, because all of them will be excuses, okay, of telling why they perform badly. So that's why management, I've seen a lot of reports, and often the case, when their profit is not so good, okay, you know what they will headline? They will say that earnings, okay, they will use EBITDA, earnings before interest, okay, depreciation and so on, because they have a lot of debt. So if they use EBITDA as a measurement, then it wouldn't tell that they have a lot of debt, and because they have to service that interest, therefore their earnings have been wiped out. Okay, so companies always play these kind of things as well, So like last year, we did something about, I think, value stock investment or something, where we talk about Nestle. Okay, now Nestle Malaysia ROE, return on equity, is fantastic. It's the highest among some of the companies that we shared during that webinar. Okay, and Nestle return on equity is, I think at that time, if I recall correctly, it's almost 100%. Wow, when it's 100%, then I look at what the analysts from this bank say and that bank say. They say buy. Return of equity is 100%. Where you cannot get this kind of KPI from other companies as well. But then if you look into that balance sheet, you will know why the ROE is so high, because the debt level is fantastically high. Because equity is net assets, total assets minus total liabilities. Therefore, then only you have the equity. But because your debt level is so high, it destroys your equity. So when you have a certain profit, that profit divided by that equity, okay, gives you an ROE that is fantastic. Okay, so that is why you need to know in detail. Understanding the company financial. It's not just because some analysts that use ROE as a guideline, and then it's decided that this company then is a buy, and then you buy. Okay, but you buy without knowing the underlying financial. Okay, and then in this case, the Nestle management will focus on the top line, but they are using leveraging on the debt, okay, to acquire companies perhaps, okay, so that they can continue to build their top line. It's not that it's wrong, okay, it's just that my requirement of a company then is different, because when you have a higher debt, a very large debt, okay, and then interest start to rise, what will happen is that it will hit the earnings, because the interest of servicing that debt becomes very high. Okay, hopefully I think it's been a few quarters since then. Perhaps the balance sheet has improved, okay, which is a good thing then. Otherwise, if a company start to, not necessarily Nestle, but other companies, okay, they start to, the management, okay, use different type of financial engineering to deliver a good figure, then you have to be suspicious on what's really are they hiding. Okay, for example, another thing that management likes to do is actually announce purchase of shares. Okay, so each time they purchase back the company shares, what will happen is that the amount of shares in circulation would be reduced. So when the amount of shares in circulation is reduced, what happened to the EPS? That EPS would be boosted high because you have the same amount of profit between now versus previous. So your EPS would actually be increasing. So because the EPS increase due to your share buyback, when you have the PE ratio, a lot of people like to use PE ratio, okay, to gauge your companies whether it's undervalued or not. No, to be frank, I don't know. I don't always look at PE ratio, okay, because I find that companies can still buy back a lot of stocks and all those, and then that EPS, is boosted. So what happened is that the price to earnings ratio then becomes low, and it gives the belief that the company is undervalued. Okay. Now another thing that I sometimes notice is company actually don't have money to buy back the shares, but what they do, they borrow a lot of money to buy back the shares. So what we see then will be a company that's settled by debt just to reduce the number of shares to project a high EPS, and therefore, people perception then would be, oh, the PE ratio is low, so this company is worthwhile. Okay, in that case, okay, what happens then if interest rate increase, okay, and economic conditions are unfavorable, then you have shareholders holding the bag with a lot of debt which need to be serviced. Okay, so that's why management will use a lot of ways, okay, to project as good a picture as possible. But when performance is bad, the review of performance normally is especially long because there's a lot of excuses. They say why the performance is poor. Normally they blame other things except themselves. Okay, so these are the kind of things that you should look at. If the company's management is very engaging, they know what the shareholders want. Okay, they engage with the shareholders. They tell the shareholders what is the direction, what they want to do. Okay, then that company management is top class. Okay, you will know, you will have confidence in this management. Okay, and that is when you will decide, hey, I not only understand the financial of the company, I know its potential. Okay, and despite the economic conditions, the management have shown what they are going to do. Okay, what are their plans, how they want to ride that economic crisis, how are they going to ride that financial crisis to deliver shareholders value. Now, if a management can disclose all this, which means the management actually have a plan. If the management can just tell you, give reasons why it's bad, okay, then this company you really have to consider, because it's like, if it's bad, it's bad. It's not that if it's bad, we are going to do something about it. Okay, so think about all these things. Okay, now risk can be low, medium, or high. Knowing the level of risk allow you to allocate your cash resources accordingly, depending on your risk appetite. A lot of people, when they invest, they do not know what are their own risk appetite. Okay, so sometimes they say that they would think that an investor would think that, hey, if I'm planning this 1,000 ringgit investment, I am prepared to lose 20%, and then I cut my losses. Okay, but some, they would say, they invest that 1,000, okay, then when it drops 20%, they will often give themselves a very normal excuse. Hey, it's all right, 20% is only paper loss. Okay, a loss is a loss, whether on paper or not. Okay, what if from that 20% paper loss, it becomes to 40% paper loss, and by that time you cash out, it will be 40% actual loss. So sometimes when you must understand your own risk appetite. At what level do you want to get out? Okay, now understand the financial strength. Now this is the income statement of a company called REITs. okay, and the balance sheet. So very importantly, okay, you must know what's in the income statement, okay, whether the earnings, okay, is higher than last year, okay, in this case here, okay, whether revenue is higher, okay, now in this case it's 221 million versus 170 million, okay, that's quite a good growth, okay. Then when you look at the earnings itself, okay, it's also an improvement. Now when you look at assets, very importantly, few things you must know: current assets, okay, and the current liabilities. Now current assets must always be higher than current liabilities, because the current liabilities are costs, okay, or liabilities which the company must fulfill, okay, must pay off within a 12-month period. So that's why current assets cannot be less than current liabilities. Now, if you select a company, when you look at the balance sheet, when the current assets is less than the current liabilities, what will happen within the 12-month period? The company would likely need a revolving credit, maybe a 12-month revolving credit, okay, to help pay the 12 months of liability. So any credit is an increase in debt, okay, and that is when the company would incur interest on that debt, okay. So current assets, remember, must always be more than current liabilities. Then another thing gauge which I often look at is total liabilities must always be higher than the total equity, okay, because that is the leverage ratio. Now when total liabilities must always be less than the total equity, because total liabilities actually accounts for the leverage of the company. The higher the total liabilities versus the total equity, then you know that the company is incurring a lot of debt. Now, as an example I used just now, if let's say your total liabilities is very huge, especially non-current assets, okay, because those are long-term borrowing, therefore your total equity would be destroyed. So like companies would then, sometimes they have good profit for that particular month, for that particular quarter, then they would boast, okay, our profit over our return on equity is so good, okay. So sometimes, not to say that analysts who do recommendation are always on the wrong side, but sometimes I think that analysts, when they put forward, their criteria are very different from yours, okay. When they put in their recommendation, their criteria maybe would be on growth and potential, okay, and not as financial risk, okay. But as an investor, if you are a retail investor, okay, you don't have millions of ringgit backing you, okay. You are just going to make do with whatever investment you can afford to, in the hope that there is capital appreciation. And therefore, what I share here normally is based on my experience as a retail investor, okay, because those are the things that I look for. I do not want to see my capital that is invested being destroyed, okay. That is why I prefer to look at financial risk. I prefer to look at things that can make a company go under, and therefore I pay a lot of attention, okay, on the balance sheet, okay. Not to say that other analysts are wrong, okay, but they have a different criteria, and you as a retail investor have to set your own criteria, whether you will want to go for growth and all those and listen to what other analysts say, or because you have very spare amount of money, you want to know that your money is being used wisely and profitably. But the most important thing before any investment is not to think about how much money you will make, but how to minimize your risk in the event things turn sour. Now, I often adopt a worst case scenario, okay. Now, as long as I know that the balance sheet is good and the company is showing improvement in the revenue, then I'm quite happy, okay. It doesn't mean that I must look for very high revenue, very big expansion, a lot of budgets, but meanwhile incurring a lot of debt. I will not be excited by that, because I also know that in so doing, the risk level would also be increasing. Okay, so this is what I mean by you need to understand the financial strength. Okay, there must be profit growth, there must be revenue growth. Current ratio, the current assets divided by the current liabilities must always be more than 1. Okay, total liabilities, okay, should never be more than total equity. Now, unless certain industries, okay, that relies a lot on that, that is called the capital intensive industries. Okay, for example, like construction, okay, they need a lot of heavy equipment. Like property, you need to secure a piece of land, okay, or also those in the oil and gas industry, okay, very capital intensive. In the shipyard, okay, in the aircraft, in the airline industry, you need to purchase, you know, big stuff, okay, very capital intensive investment before they can do their business. Then I would have some leeway, which means I would allow the total liabilities be more than the total equity, but not exceeding. For example, I set the maximum as, you know, total liabilities cannot be more than 1.5 times the total equity for capital intensive industry. Now for Vitrox, okay, they are not a capital intensive industry. They have a plant, but then they keep on producing from that particular plant. Okay, therefore the total debt over the total equity cannot be more than 1. Okay, because there's no reason to, because it's a production, just as with other consumers, consumer companies. Okay, they don't need to continuously to increase plant just to increase production. Okay, they can actually increase it to having more amount of work. Okay, having the plant run longer hours to actually produce goods. So that's the differentiation. Now, in knowing the growth potential, now this is the chart, okay, the annual performance chart for Vitrox Corporation. You can see that the revenue, you know, starting from here, you know, has been trending up very, very nicely. Okay, so even in the profit after tax, okay, is 6.5 here, okay, but here, okay, is 65, sorry, not 6.5, 65 here, but here, okay, it's only at 9. So you can see that, you know, since about 10 years, okay, their net profit, okay, profit after tax have increased by more than 7 times. Okay, so when we compare 2016 versus 2006, okay, revenue has increased 975%, profit before tax has increased 610%, okay, and profit after tax 722%. Okay, so this is what I mean by potential. Okay, when, for example, you may not necessarily be buying here, okay, at the start, but let's say you're buying here, you know, you let's say from here there's a certain boost, okay, from let's say 18 to 88. Then, you know, if you have bought somewhere here, hey, the upside, you know, is still quite fantastic from here to here. So that is what I mean, that sometimes you need not necessarily, okay, buy, you know, at the IPO stage or somewhat, because, you know, not to forget that after reaching a high here, there's a downtrend. Okay, in which case I think during this downtrend, okay, the share price could have fallen somewhat. Okay, so always look out for companies which certainly exhibit a good quarterly performance or annual performance, which sees its revenue and profit after tax exploded on the upside. And when it exploded on the upside, okay, look back against the financials, the balance sheet, to ensure that, hey, you know, this explosion is actually you know, is actually due to what the management does, rather than, you know, acquire or buy over a new company, okay, which then incur debt. Okay, so sometimes you have to study all this to really determine whether that particular company is worthwhile for you to invest in. So the other thing is knowing the prevalent economic conditions. Now, source your information from Bursa portal, okay, local business news portal, okay, for example, The Age, Then you have DH is actually pretty good. Okay, they actually tells a lot of things. Okay, then Bank Negara statistics. Okay, international news portal like CNBC, Bloomberg to know what are happening in the global market that could influence the Malaysian market. Then do Google search to find out things that you do not know or do not understand. Okay, for example, just now I talked about debt to equity ratio, current ratio. You can just Google search and then learn from that. Okay, and then you will be better at what you do. Now, global economy conditions can influence certain sectors of the local economy. For example, okay, if let's say US dollar is weak, okay, those that export in US dollars, okay, may be affected, okay, unless they increase the price that they intend to export, okay, higher in US dollar terms, so that the ringgit, okay, they protect their earnings in ringgit. Now, if let's say they do not, they fear that by increasing the amount of US dollar, they could lose their market, then what happens is that because the US dollar is weak, then the amount that the ringgit that they gain, okay, would be less. Now, if let's say US dollar is strong, then the amount of ringgit that they gain from the export section, okay, will actually increase, and that would help improve the bottom line. Okay, then again, monetary policies from US, EU, Japan, and China can influence the ringgit and Malaysia's foreign trade. Now, some example, if let's say, okay, US, the Federal Reserve decides to hike interest rate. Now, as you can see, the Federal Reserve has been hiking interest rate for several quarters. So what happened? Okay, eventually Malaysia will also increase the interest rate like recently. Okay, because an economy cannot just, run by itself outside the influence of others. Okay, why the as the Federal Reserve increase interest rate, why Malaysia also need to increase interest rate? Now, if let's say US increase interest rate, but Malaysia does not, that means that people then would prefer to hold US dollar rather than hold ringgit, because hey, because of US dollar increasing in value, because the Federal Reserve is also hiking rates, then people would decide that, hey, I do not want to keep Malaysia ringgit, I might as well buy US dollar, because US dollar is appreciating. Okay, then that could impact Malaysia's ringgit value. So that's why if US dollar is increasing, Malaysia also need to keep in tandem so that there is an equilibrium. Okay, but right now, okay, US dollar is weakening. Okay, so in that sense, it will affect those companies that are export oriented, where its transaction is done in ringgit. But then China renminbi is actually increasing. Now, if let's say there are certain companies that does trade with China, and instead of using US dollar, they are using the renminbi, then of course, in terms of ringgit wise, the bottom line would be improved. So these are the things that you must know, okay, or not necessarily must know, but then make an attempt to know, so that you know how external forces could impact the performance of a company. And by knowing all this, you can just be better knowing the company, and therefore, have a deeper commitment, okay, in your investment, okay, rather than just relying on what analysts say, okay, or what other friends are telling you, okay, because everything is based on your own conviction, okay, that you have done your analysis, you have done your study, and it reinforces your confidence, and therefore it should not be easily swayed. Okay, so understand management directions, things that you must look out for. What are their priorities in the current financial year? Are they meeting their respective targets? Okay, what are their concerns? How are they going to address them? So these are the questions that you must ask, and to see whether that management review of performance in the quarterly report underscores your concern, okay, and their concern, and telling what remedy they are going to take, okay, to reduce, let's say, expenses, to reduce their interest payments and such. Okay, so I think I've elaborated quite a lot just now, so I shall not talk so much about this, but these are the questions that you must always ask. Now, understand the rewards. You must be practical in assessing the reward potential. Never set too high a target. Okay, don't invest and say that someone told me this stock will go up 100%. Okay, it's not as easy as that, because you must know your own risk. Okay, what is your risk acceptance level? Yes, it can go to 100%, but what if that calls for you holding it for 5 years or 10 years? Okay, what if, let's say, if you have done your due diligence, you have another company that gives you 30% every year. Okay, then you could easily have achieved that 100% in 3 years time. Okay, so improve the level of your profitability by setting priorities. What is the dividend yield you are looking for? Okay, for example, dividend yield is actually the dividend divided by the share price times 100%. Okay, what is your profit target? Now, sometimes people set a profit target, they can be very rigid. For example, I say, if the share price appreciates 10%, although I will sell, okay, that's it. I won't care for any other thing. Now, that is a very stubborn approach to setting your profit target. Because what if a company performance starts to exceed expectation continuously, as I mentioned just now? Okay, so when that happens, okay, your profit target has to be reviewed on the higher side. So you're not necessarily have to force yourself to sell at 10%. What if in 1 year's time you can achieve 50%, because the company quarterly performance keep on improving, and each time investors are coming to support that company. Okay, so don't be too rigid with your profit target. Have allowance, okay, that you can make more, but meanwhile know when to cut your losses, and don't hope that if things turn bad, it will turn well in the future, because it's about capital allocation, efficient capital allocation. If something turns bad, yes, you can say 1 quarter, I'll wait and see. But if, let's say, by the 2nd quarter, it's also turned badly, then I think it's time to call your quit, okay, and look elsewhere. Because each time, okay, you're holding onto the stock, you're missing other opportunity. So one thing you must understand, how long can you afford to stay invested in the stock? This will determine your strategy, whether to trade or to invest long term. Okay. Some people are just interested in trading. Okay, they do not want to invest on the long term. But okay, to really capture as many opportunities as possible, if you have a particular sum, set aside a majority of it, okay, for long-term investment, okay, a certain portion for short-term trading, okay, so that you can have the cash flow, okay, to look out for better investment opportunities. Okay, so you must also understand what is your exit strategy. How much loss are you willing to take before exiting? Okay, don't be too stubborn. And a loss is a loss. It is never a paper loss. Okay, because if you can accept a loss, okay, then you will know how to treat your investment like a business. Just like in a company, do you think they will announce to the shareholders, oh, we lost 100 million this quarter, but don't worry, it's only on paper? Okay, now if you are the investor, will you be very angry if you hear that from a company? So you have to treat that your investment is like a company. When it's a loss, accept it as a loss. Okay, just as you cannot accept a company telling you, we have 100 million that's being wiped off, but hey, don't worry, our assets is worth much more, although our cash flow now is is being affected, but never mind, it's a paper loss. The Securities Commission will never allow a company to tell you that a loss must be disclosed, okay, to the shareholder. Okay, anything that that whether it's an impairment cost, okay, or a write-off, it must be made known to the shareholder. So that's why if your investment has gone sour, okay, just write it off. Okay, so don't think or don't hope that things will turn around the corner, because if, let's say, the loss continues, you will just have you will just dig a bigger hole for yourself. Now, another thing that I would like to share with you is that sometimes when the stock is coming down, okay, a lot of people like to say, those some people say, don't worry, if you read certain books, they will teach you about average down. Okay. Now, to me, I don't really encourage average down if a stock is falling, unless you know what's happening. Now, if a stock is falling, there must be a reason why that stock is falling. Don't, before you even do a check to see whether the stock is falling because of some bad news regarding the company, or you see the stock falling, hey, because I bought at a higher price, now it's a good time to enter at 50% discount. So what is the stock after you enter at 50%, it drops another 50%. Means then out of the 100%, your first initial investment has fallen to 25%, and your 50% from there has also dropped to 25%. So, you shouldn't be averaging down unless you know that company is doing very, very well. Okay, it's just that people are unloading their shares because they are moving elsewhere, perhaps. Okay, so if that company's performance is still very strong, okay, and there's institutional investors decide to sell off, okay, but the company performance is still good, there's no bad news, then yes, you can average down. Okay, but don't average down, at 10%, at 20%. I will average down when it's 30 or 50. Okay, but there must be a huge gap so that you can really see the effect of average down. If let's say the stock dropped 10%, is there any reason why you should actually throw in, when assuming you buy a share at 5 ringgit, it went up to 6 ringgit, then it fall back to 5 ringgit and 50 cents. Does it mean that you should buy at 5 ringgit and 50 cents? No, that's not average down, that's average up already. Okay, so it must fall quite substantially. For example, it must have dropped to 3 ringgit, and then you bought at 5 ringgit, then you buy again at 3 ringgit, then it makes sense because your average cost now is lower. Okay, so don't see every opportunity that it dropped 10%, 15%, then you think, hey, it's time to buy. Okay, so always know what is your cost outlay. Okay, so if you are a value investor, then dividend yield really matters because you're holding for a long term. You like that particular stock to deliver you a dividend so that you have steady income stream. Okay, but if you are holding for the long term, if you are a value investor, then you need to read and assess the company's performance every quarter. Now, understand the transaction cost. Every transaction has a cost besides the total value of the shares. Okay, you have brokerage fees depending on the firm, can be 0.1% or 0.7%. Clearing fees, which is 0.3% and a maximum of 200 ringgit. Stamp duty, 100 ringgit per 1,000 ringgit transaction.
Clearing fee is a maximum of 1,000 ringgit. Yeah.
Okay,
there's a mistake there. Yeah, it's a 0.03% and a maximum of 1,000 ringgit.
Okay. So stamp duty is 1 ringgit per 1,000 ringgit transaction and a maximum of 200 ringgit. Brokerage fees and clearing fees are subject to 6% GST. Now, the total cost for transaction, let's say for company XYZ, you have the share price plus the brokerage fees plus the clearing fees and stamp duty plus GST. Okay. Now, in this case, okay, assuming the value of the shares is 5,000, brokerage fees at 0.3%, total cost of the transaction will be 5,000 plus 15 ringgit, okay, plus 1 ringgit and 50 cents, plus 5 ringgit and 99 cents GST. Your total transaction then will be 5,000 ringgit, 22 ringgit and 49 cents. Okay, this is a rough calculation how you can actually work out. Now, the best assumption sometimes, okay, is to assume, if let's say it's here, you can safely assume that it's around 0.5% in total or 1%. So that's sometimes that before you buy, you need to do all this calculation. Normally, I don't go into that detail. I mean, to be frank, because it's just difference of just about it's just 0.5%. Sometimes I just round it up to 1%, so that I know that that's my maximum exposure. And yes, you can go into this detail. It's nothing wrong. I just look at it, that as long as less than 1% is okay. All right. So every investment carries with it a set of costs. They are the opportunity costs. This is the cost which you incur when you choose investment over other ventures. For example, you decide to invest 5,000 ringgit in the share market versus putting the same 5,000 ringgit in a fixed deposit. Now, this is very important if, let's say, you are investing for dividend. Now, if you invest in a share, okay, mainly for dividend purposes, and it gives you a yield of less than what the FD is offering, then you really have to question, why do you want to invest in that company? You might as well put it in the FD. Of course, then the other thing you look at is capital appreciation. So that's why if you are investing in a company with very low dividend yield, okay, you have to look at capital appreciation. Then again, that is setting your priority. Whether you want to invest for capital appreciation or invest for the dividend. If let's say it's dividend, okay, and you are a very long-term holder, you are not looking at cashing out, then that dividend yield must definitely be higher than the FD rate. Otherwise, it defeats the purpose of investing. Okay. Then also the holding cost. Now, this is a cost when you invest with borrowed money rather than using your own money. Okay. And as long as you haven't sold your investment, you will have to continue paying the interest. Okay. So sometimes people take a personal loan, okay, because the market is hot. I'm going to take a personal loan and I'm going to invest in it. Okay. So when you do that, okay, your investment must really pay off in that 1 year, so that is definitely more than the interest you pay for your loan. Okay. Then loss. When you sell at a loss, it is a cost to you. Now, to a certain, you manage your investment well, you can set your own ROI, return on investment, so that your investment strategy will deliver to you an acceptable level of profit. Okay. So understand a company's financial. A company's financial often consists of the quarterly report, which is reported at the end of every quarter, and the annual report. Below are some of the most common items found in both. Now you have the summary of performance, okay, which is the headline. And this headline, normally, if it's bad news, the company try to paint it in a good picture. Like instead of using EPS, they use EBITDA. Okay, income statement, balance sheet, cash flow statement. Okay, explanatory notes. Okay, this is what the management will talk about. This is what certain items, okay, big ticket items, they will explain it in the notes below the income statement, balance sheet, or cash flow statement. Then they have the dividend statement, if any. Then review of performance, and this is where the management will talk about in detail the performance. Then statement of changes in equity, director's statement, annual report only. Okay, this is when the directors of company like CEO will talk about the company's past performance. Okay, list of substantial shareholders normally is only in the annual report. Okay, and list of properties, which is also normally in the annual report. And this is where they list down their assets and things like that. So most important financials, I often look at it, are the quarterly report, where you have the summary of performance, income statement, balance sheet, cash flow statement, and review of performance. Now you have to read the income statement and balance sheet for updates on company performance and financial strength respectively. Now a company may have very good balance sheet on one hand, and suddenly due to an external shock, okay, might see their balance sheet unraveling, okay, with huge debt. So don't, because when you put in your initial money into a particular company, the balance sheet was strong, you treat it as though the company will be as strong forever. Okay. Now, just to share with you a bit about Maybach. Many years ago, Maybach used to be pretty strong, okay, financially. Then what happened in the aftermath of the financial crisis? What we had was a commodity bear market for about 4 years. That's when Maybach started to perform very badly, because Maybach shipping rates, they follow the Baltic dry bulk index. During the height of the demand, okay, in 2009, okay, the Baltic index, was about 12,000 points, if I'm not wrong. Okay, so what happened was then, because it reached 12,000 points, a lot of companies, invest in dry bulk shipping. Okay, they build new ships, okay, to expand the capacity and so on. but then the bear market happened. So when the bear market happened, you have an oversupply of dry bulk ships. So then, of course, the rate would fall. So the Baltic index actually fell as low as, I think, in 2015 or 2016. It fell to a low of, from 12,000 over points, it fell down to about 197 points. That's when it hit Maybach very, very badly. Okay, so I think we covered Maybach last year or so when we did about turnaround stock. Okay, so but I think recently Maybach has been gaining a bit because the Baltic index, have moved up to about 1,200 points. Okay, so then again, just as I was saying, you must know some external stuff. Like when you look at Maybach, okay, local company, okay, but then its shipping rate depends on the international dry bulk shipping, which is the Baltic dry bulk index. So you must know that, okay, rather than knowing just looking at the financial. Hey, I don't know when they will recover and all. If let's say you see that's an uptick in commodity price, then that would signal that the demand for dry bulk will actually increase. Okay, and then you would have made a decision to buy Maybach, because then you would be sure that there will be an improvement in in the company's performance. So this is how you will get certain information well in advance. Yeah. So you must also know the cash flow statement, okay, which allows you to understand how the company manages its cash flow, whether a company is using its cash for the right things. Okay, like sometimes a company may have a very large, cash at hand. It's like the company is suddenly so rich. Okay, but then they actually took a very heavy loan. Okay, they actually borrowed a lot of money. So that's why cash at hand now is a lot. So that's why you must understand what transpired. Okay. So then also refer to the explanatory notes and review of performance to assess management take on any discrepancies. So for example, there could be a major write-off, okay, or a major impairment cost. These are costs to the company. So you might want to know why it happened. Okay, is it a one-off thing? Okay, or is it something that will hit the company very badly? And what is the management statement on this issue? Okay, so especially when it pertains to impairment costs and write-off, it can be, if let's say it's very, very significant, you need to understand why. So understand economic indicators. How well a country performs will influence its stock market. Key indicators are GDP growth and inflation data. Now, for example, sometimes we just look at GDP growth, and inflation data is something that we treat related to just the price of goods, whether things are getting expensive or not. But another thing which you can look at is to look at the real GDP growth, which is GDP minus the inflation. Okay, so for example, if let's say the country's GDP is, let's say 5+%, but inflation data is about 3%, then which means our real GDP growth is actually 2%. So that's why if inflation data is inflation is still low, but then GDP growth is much higher, then you know that that's the company, the country's economy is really on the strong ground. Okay, but if let's say a country's GDP, okay, is 5%, but then the inflation data is 4%, then the real GDP growth, okay, is going to be quite low. Okay. Now, export and import data are also called the trade data, industrial production index, and consumer price index. These are the things that could influence the country's performance. Okay, GDP growth measures the strength of the economy. Inflation data affects Bank Negara outlook on interest rate, which affect the overall economy. Now, all these data are available at www.statistics.gov.my. So that's the end of our session. To the questions.
We have come to the question and answer session, but we only have 10 minutes left. So I will just quickly go through the questions, and then I will just select questions that I think is more relevant. Now, the first question I see is about pre-opening price, like how about the price that you key in before the opening of market trading, and how will it match? Okay, just let me explain. So if you key in an order before the market opens at 9 o'clock, at 8:30, from 8:30 to 9 o'clock, or from 2 o'clock to 2:30 p.m. before the market start for session 2, then you will queue your order as the price that you indicate, and as soon as the market open, then Bursa will try to match your order with the buyer or the seller that offer the price that you want. So that's about pre-opening price. And then there's one question on how do Bursa makes money. So of course Bursa makes money by listing fee. Bursa makes money several ways. First is by listing fee. When people go IPO, they have to pay the listing fee, and secondly there's a volume trading fee that they charge, which is a clearing fee. So when you pay stamp duty, it is paid to the government. When you pay clearing fee, it's paid to Bursa Malaysia for doing the clearing of the stock for you. The GST of course is paid to the government, and lastly is the brokerage fee is paid to your broker. So the next question is, I think today our Prime Minister announced that there will be a stamp duty waiver for 3 years effective March 2018. And what is your view of this?
Well, I think anything that can help save costs, would be good for the industry. So this stamp duty, is it on trading or on property?
No, actually it's on the small and mid cap. But of course, the Prime Minister did not disclose so much details yet. So let's wait for the Bursa or the respective regulator to give more details as to how the waiver can be done. Yeah, it was announced by the PM at the World Capital Markets.
Okay.
So it also allows the intraday short selling, by the way.
Intraday short selling.
Correct. Today announced that it is allowed already. So the next question is now in relation to the recent 2 days bear market. So the question is, after flash crash yesterday, I mean the last Friday and today, and yesterday, question is, are we entering a bear market, and how long will it last until the next bull run? This question on it.
I think things are really not so rosy, despite what is coming up from the US. First and foremost, 8th of February is a date that you need to look out for, because that's when the government, the Republicans and the Democrats would fight over the continued funding of the US government. Now, why is that happening? Because US government is actually insolvent. They got no money to run the government agencies. And on top of that, the US government is sitting on the highest debt on record across all sectors. For example, government debt is the highest on record. Non-financial institutions debt is also highest on record. Consumer debt, student loan, and auto loans are also the highest on record. So with so much debt, that's on record, any increase in interest rate, which the Federal Reserve have indicated it could be 3 or 4 interest rate hike this year, would definitely impact upon the ability of a lot of companies and individuals to service their debt. And not only that, the cost of borrowing from the US government would increase. Because of that, that is why we are seeing that people are selling off the US bonds, and that's why there's a fear in the market of hiking interest rate, and therefore there's a sell-off. So if you ask me whether it's going to be a bear market, I think it would depend on the next few days. And if, let's say, the US government decides to kick the can down the road, which means no solution at hand, people would be losing confidence in the market. We may be seeing a very huge bear market, because meanwhile, all the central banks are tightening on their liquidity. EU banks are actually halving they are also tapering their QE. Japan is running out of government bonds to buy, and that's indirectly tapering. China has increased interest rates slightly, and the US is now currently doing quantity tightening, which is pulling liquidity out from the market. When liquidity is being pulled from the market, which means there's not much money to support the stock market as well. So a lot of very challenging stuff. If you ask my opinion, I think we are in for a much longer bear market. And today, you know, the stock market looks like it's going to fall again. So tomorrow, don't expect the KLSE to go up. If let's say the drop, you know, is by another 800 or 1,000 points tonight. Okay, so before you do your trading tomorrow morning, look what happened in Wall Street overnight.
Yeah, so the next
Yeah,
question
that's fine.
relates to what you said earlier. So what is the correlation between Dow Jones and KLSE?
Now, the US stock market is the world largest stock market. So it only shows like whatever that happens to it will influence the global market. If you look at it, the global financial crisis is basically a US problem, but then it hits the KLSE back down to about 800 over points during that time. Okay, from about 1,200 plus, you know, it fell back down to about 800 over points. So that's how the US market would actually affect the entire world. Okay, because they are the largest market, the world largest capital market. Okay, and that's why, you know, anything that happens to it will spread across.
Okay, so so what sector do you think, what investment sector is ideal at the moment? What industry? This question.
If let's say you are hedging against a potential sharp fall across all sectors, because if let's say US continue to crash, it will, you know, the sell-off would occur across all sectors, and no sectors will be spared except maybe, okay, something which you can hedge against. Because if everything else is bad, okay, gold would actually go up. And recently, I think Bursa have announced that Wong have launched a gold ETF. So that the gold ETF is something which you can consider as a hedge against a falling market, because right now we have a falling US dollar, which means that gold price will continue to go up. Okay, and if let's say market uncertainties, then everyone will shift from risky asset to safe haven. Okay, which likely could be US dollar as a safe haven. Okay, despite a lot of problem with the US dollar, which I think in the long term the US dollar is going to be quite badly hit in terms of value. Okay, but as long as US dollar is weak, gold will continue to go up even stronger. But even if US dollar is not weak, okay, but because of the uncertainties and potential spread of the crisis across, okay, it will be beneficial to gold. So you can actually capitalize on the rise of gold price by moving into the gold ETF.
So the next question is, what is the role of a market maker other than creating volume transactions?
I think they to a certain extent can have some influence in the way that the price of the share is concerned. But I think like sometimes the information that is being put through by the market makers. Okay, I do not know how in detail actually it works. But Shane, you can explain better. But my experience when I was dealing in the UK market, where the presence of market makers is very strong, you can see some huge fluctuation in the price, and that's how they often look at where the price position are, and they try to influence to maximize their profit from that trade. So that's my experience with the UK market.
Okay, so the next question is, what is KLCI and how do they get the value?
Sorry?
What is KLCI? How do they get the value?
KLCI is the KL Composite Index, but I think right now it's called the FTSE.
Bursa Malaysia, FBM KLCI.
Yeah. So that index actually comes from the component stocks within the that comprise of the KLCI, and that value is actually from the total share price of those stocks.
Yeah, so it's a basket of stocks that contains the 30 largest market cap companies in traded on the Bursa stock exchange. So if you want to see the indication of the market strength, we look at the 30 largest companies trading on Bursa Malaysia to see whether the market is on that day, the stock market on that day is going up or going down by benchmarking the FBM KLCI, which tracks the 30 largest companies listed on the stock market. Alright, so maybe we can do one more question. What is the relationship between GDP and inflation?
Okay, when an economy starts to grow, you have to look at it in the demand for services and goods. So when an economy expands, the demand for goods and services will also expand. But sometimes there may not be enough goods or services to supply. So then what happens is that, you know, the price would gradually increase. Okay, so sometimes you can say that yes, greater GDP growth would result in higher inflation. Okay, so that's why Bank Negara would step in to prevent the economy from overheating. They will actually increase interest rate so that then inflation is brought down. But because they increase interest rate, the cost of doing business would also increase. So what normally happens is that when interest rate rise too fast, then what follows after a period of inflation would be a recession. And in a recession, normally you have price deflation, which means because there's lesser demand for goods and services, the price will actually decrease. So this is what we mean by actually the economic cycle. Yeah.
All right, so thank you so much for tuning in for our Bursa Malaysia webinar, and we've come to the end of this session, Master the Game of Stocks, and thank you so much, PC, for being a speaker again. So once again, thank you so much for tuning in. I wish you the best in trading and investing in the Bursa Malaysia, and see you at the top of the trading. All right, so thank you and God bless.
Okay, thank you. Good night.
Have a pleasant evening, everyone.